Picture this. A small business owner in Texas walks into his bank in early 2022. He's been running a successful HVAC company for 15 years. He needs to refinance a $500,000 loan to buy new equipment and hire 3 more technicians. The loan officer pulls up his file, types for about 30 seconds, and slides a piece of paper across the desk. The rate, 3.2%. The business owner signs without blinking. It feels like a win. Fast forward 18 months. Same business, same owner. He needs to refinance again, this time to survive a slow summer. The loan officer pulls up the file, types for 30 seconds, and slides a new piece of paper across the desk. The rate, 7.8%. Same borrower, same business, same collateral. But the number on the page has more than doubled. He asks the loan officer, "What changed? Did I do something wrong?" And the loan officer gives him that same corporate smile and says, "The market moved." That is not an answer. That is a shrug wearing a tie. So here is the actual answer. That number was not picked by his bank. It was not picked by the Federal Reserve. It was not picked by Jerome Powell yelling into a microphone on a Wednesday afternoon. It was set by a market that almost nobody has ever looked at, a market worth roughly $145 trillion. That is bigger than every stock exchange on planet Earth combined. Bigger than the New York Stock Exchange, bigger than NASDAQ, bigger than all of them stacked on top of each other. And this market decides his loan. It decides your mortgage. It decides your car payment. It decides whether your landlord can afford to raise your rent. It decides whether your employer can afford to keep you on payroll. And, as we are about to see, it decides whether your supposedly safe retirement account quietly loses 17% of its value in a single year while you sleep. This is not a video about some boring thing that rich people buy. This is a video about the invisible machine that prices your entire life. And almost nobody understands how it works. My name is Adler, and I have spent a ridiculous amount of time reading about a market that has all the personality of an instruction manual for a dishwasher and roughly twice the body count. If you have ever wondered why borrowing money got brutally expensive overnight, or why your retirement portfolio suddenly started moving like a crypto token, hit subscribe. Because by the end of this video, you will understand money better than most people who actually have finance degrees. And that is not a compliment to you, that is an insult to finance degrees. Let us start stupidly simple, because everybody overcomplicates this. A bond is an IOU. That is literally it. Somebody needs money. A government, a corporation, occasionally a city that wants to build a new sports stadium it absolutely does not need. And instead of going to a bank, they borrow the money from regular investors. You hand over, say, $1,000. They promise you 2 things. First, a fixed interest payment every single year. That is called the coupon. Second, your original $1,000 back on a specific date in the future. That is called maturity. Think of a bond like a financial promise ring. The borrower is literally putting a ring on it and swearing to pay you back. And unlike your ex, the U.S. government has a 248-year track record of keeping that promise. So when the U.S. government runs a deficit, and spoiler alert, it always runs a deficit, it sells Treasury bonds. When Apple wants cheap cash to buy back its own stock, it sells corporate bonds. When a company with shaky finances borrows money, those are called junk bonds, which Wall Street politely renamed high yield, because the word junk does not look great on a glossy brochure. Now, here is the part that 90% of people get wrong, and this is the single most important idea in the entire video. So lock this in. Let us say you buy that $1,000 bond paying 2%. You get $20 a year. Fine. Boring. Whatever. A year later, interest rates rise. And brand new bonds, same $1,000, same borrower, now pay 5%. That is $50 a year. Question, who is buying your bond now? You walk up to an investor and say, "Hey, want this thing that pays $20 a year?" And they look at you like you just tried to sell them a flip phone in 2024. They say, "Why would I do that when the government is handing out $50 a year right next door?" Your bond did not change. It is still paying exactly what it promised. But it is now the financial equivalent of a Blockbuster gift card. It still works. It still has value. But nobody wants it at full price anymore because Netflix just opened across the street. The only way to sell it is to cut the price. You drop it and drop it and drop it until that fixed $20 payment works out to roughly 5% for whoever buys it, which means selling your $1,000 bond for somewhere in the 700s. You just lost a couple $100 on the safest investment on planet Earth. On paper, sure. But as we are about to see, on paper has ended careers, collapsed banks, and taken down at least one world leader. So here is the rule. Tattoo it on your forearm if you have to. When interest rates go up, existing bond prices go down. When interest rates fall, existing bond prices go up. They sit on opposite ends of the same seesaw. Every single disaster in the rest of this video, every single one, is just this rule operating at a bigger and bigger scale. If aliens landed tomorrow and asked to see the one number that controls Earth's economy, you would not show them the Dow Jones. You would not show them the S&P 500. You would show them the yield on the 10-year U.S. Treasury. Right now, it is sitting somewhere around 4.5%. And here is why you should care, even if you have never bought a bond and never plan to. When a bank writes you a mortgage, it does not invent the rate out of thin air. It looks at the 10-year Treasury and asks itself one question. Why would I lend money to a random human for 30 years when I could lend it to the U.S. government, risk-free at 4.5%? The answer is, it would not, unless you pay more. So the bank takes that Treasury yield, adds roughly 2 percentage points for the privilege of you being a regular person who might lose your job, and that is your mortgage rate. 10-year at 4.5%. Mortgages at 6.5 to 7%. That is not a coincidence. That is the formula. Back in early 2021, the 10-year was sitting near 1%. Mortgages hit 2.65%, the lowest ever recorded in modern history. People borrowed money like it was going to expire. Home prices jumped 19% in a single year, against a 50-year average of about 4%. It was absolute madness. Then the 10-year ripped higher. Mortgages crossed 8% by late 2023, and the housing market basically froze mid-bite, like someone hit pause on a nature documentary. The bank did not do that to you. The bond market did, and it does not stop at houses. Car loans, credit cards, student loan refinancing, the rate your city pays to build a new school, the rate your employer pays to fund its expansion, all of it is priced off treasuries. When yields rise, every single borrower in America gets the same rate increase at the same time. It is like the entire country is on a variable rate mortgage, and nobody told them. Companies that loaded up on cheap 3% debt in 2021 suddenly faced refinancing at 7%. And when your interest bill doubles, you do not write a sad LinkedIn post about resilience, you cut costs, which is a polite way of saying layoffs. A huge chunk of the job losses in 2023 and 2024 were not really about the economy. They were about the bond market quietly repricing everyone's debt at the same time. Oh, and one more party trick. The bond market predicts recessions better than basically every economist alive. Normally, lending money for 10 years pays more than lending it for 2. Longer wait, more reward. Makes sense. But occasionally that flips. Short-term bonds pay more than long-term ones. It is called an inverted yield curve, and it means investors are so nervous about the near future that they are stampeding into long-term safety, even if it pays less. Researchers at the Federal Reserve checked the track record. That signal has correctly called every single U.S. recession since 1955, with exactly one false alarm. 9 for 9, plus 1 mulligan in the 1960s. Your horoscope wishes it had that hit rate. So while CNBC argues about vibes and Twitter argues about politics, the bond market just quietly raises its hand and says, trouble is coming. And it is almost always right. This is why the famous political strategist James Carville said back in the 1990s that he used to want to be reincarnated as the president or the pope, but now he would come back as the bond market. Because he said, you can intimidate everybody. He was not joking. And in a few minutes, I will show you the bond market intimidating an entire country into firing its prime minister in 45 days. But first, we need to demolish the biggest lie in personal finance. Quick favor before the carnage. If this video is connecting dots for you, hit the like button. It is free, it takes 1 second, and it tells the algorithm that humans actually want to understand money instead of watching another video about a cat falling off a couch. Okay, back to it. Here is what every financial advisor, every retirement brochure, every target date fund has told you for decades. Stocks are the risky part. Bonds are the safe part. 60% stocks for growth. 40% bonds as your seatbelt. It is the most repeated advice in the history of personal finance. Then 2022 happened, and the seatbelt strangled everybody. The Fed jacked rates from basically 0 to over 4% in 9 months to fight inflation. And remember our rule, rates up, existing bond prices down. The broadest U.S. bond index fell 13% that year. That is the worst year in its entire history going back to 1976. But it gets worse. Long-term treasuries, the assets that are literally considered the safest on planet Earth, got absolutely obliterated. Long-dated zero-coupon treasuries lost 39.2% in 2022. One researcher checked the records and found that is the worst year for those bonds going back to 1754. Not 1954, 1754. There were 13 colonies. We had not even invented America yet, and bonds had never had a year that bad. The classic 60-40 retirement portfolio lost about 17%, because for the first time since 1974, bonds did not cushion the stock crash. They piled on. Millions of retirees opened their statements and discovered the safe sleeve of their portfolio was the thing bleeding. So were they lied to? Sort of. Here is the nuance nobody explained. Bonds protect you from one risk, the borrower not paying you back. The U.S. government will always pay you back. But there are two other risks hiding in the fine print. Inflation, which quietly shrinks what those fixed payments can buy. And the big one, interest rate risk, which is everything we just covered. And there is a number that measures exactly how exposed you are. It is called duration. And it is the most useful concept you have never heard of. Rough translation. Duration tells you how much your bond flinches for every 1 point rise in rates. A fund with a duration of 6 loses about 6% when rates rise 1 point. A long-term Treasury fund with a duration of 17 loses about 17% per point. And in 2022, rates rose more than 4 points. Suddenly, Grandma's bond fund is moving like a tech stock, except without the upside, and without the fun. Now here is where it gets cinematic, because this exact same math, this one rule, started taking down bigger and bigger targets. First a bank, then a country, then a 100-year promise. Watch the dominoes fall. Domino 1, Silicon Valley Bank. March 2023, SVB took in a flood of deposits during the tech boom and parked over $91 billion of it in long-term bonds with an average duration around 6 years. Safe assets, remember? The most boring investments in existence. Then rates spiked, and by the rule you now know, those bonds silently lost more than $15 billion in value. The bank was not gambling on crypto or meme stocks. It bought the most boring assets in the world at the worst possible time, funded by deposits that could leave instantly. When SVB sold part of the portfolio at a $1.8 billion loss and asked investors for fresh cash, depositors panicked, and the bank went from fine to seized by federal regulators in about 48 hours. The 16th largest bank in America, killed by the blockbuster gift card problem. Domino 2, the United Kingdom. September 2022. New Prime Minister Liz Truss announced £45 billion of unfunded tax cuts. And the bond market looked at the math and said out loud, absolutely not. Investors dumped UK government bonds so hard that 30-year yields spiked more than a full percentage point in 3 days. That detonated leverage strategies inside British pension funds, which were forced to sell more bonds to raise cash, which pushed yields higher, which forced more selling. A doom loop with the entire retirement system of a G7 country trapped inside it. The Bank of England had to launch emergency bond buying, later admitting some pension funds were literally hours from collapse. And here is my favorite economic indicator of all time. A British tabloid set up a live stream of a head of iceberg lettuce next to a photo of Truss, asking which would last longer. The lettuce won. She resigned after 45 days, the shortest premiership in British history, because the bond market fired her. Carville was not exaggerating. The bond market can intimidate everybody, up to and including the person running a nuclear-armed G7 country. Domino 3, the small one that says everything, Austria. In 2020, Austria sold a 100-year bond. Matures in the year 2120, paying a coupon of 0.85%, and investors bought it enthusiastically. Why would anyone lock up money for a century at less than 1%? Because of where the world was at that moment. Roughly $18 trillion of bonds globally had negative yields. Investors were literally paying governments for the privilege of lending to them, the financial equivalent of tipping someone for borrowing your lawnmower. Next to that, Austria's 0.85% looked like a luxury product. Then rates normalized. The negative yield pile evaporated, and that century bond lost roughly 75% of its value from the peak. It is a rock-solid government that will absolutely pay every penny back in 2120 to the original buyer's great-grandchildren. But everyone in between owns a sovereign bond that performed like a meme stock without the Reddit memes. One rule: a portfolio, a bank, a pension system, a country, a century-long promise. Think, after all that, the biggest borrower on Earth would be playing it careful right now. The single largest borrower in the history of money is the United States government, and its tab is currently around $39 trillion. Now, big debt numbers are basically white noise at this point, so let me give you the one stat that actually matters. This year, the U.S. will spend over $1 trillion just on interest, not paying down debt, not building anything, just interest. the minimum payment on the national credit card. For perspective, that is more than the entire defense budget. The United States now spends more money servicing old debt than it spends on the most expensive military in human history. Interest is now the second biggest line item in the federal budget, behind only Social Security. And on the current path, it eventually takes first place. Imagine your credit card interest costing more than your rent, and your plan is to just keep the card. The bond market noticed. In May 2025, Moody's, the last major rating agency still giving America a perfect score, downgraded the U.S. For the first time in over a century, the United States does not hold a top credit rating anywhere. The country did not change overnight. The math just stopped being ignorable. Debt around 100% of GDP and climbing. Deficits near 6% of GDP in a year when nothing is even technically wrong. And the customer base is getting picky. Foreign investors used to hold over half of U.S. Treasuries back in 2008. Today, it is around 30%. China's holdings are the lowest since 2008. So Washington needs to borrow more than ever, exactly while its most reliable customers are slowly walking toward the exit. What does any business do when demand softens? It offers a better deal. In bonds, a better deal means higher yields. We even got a live demonstration. In April 2025, after a chaotic tariff announcement, investors started dumping treasuries. Yields spiked. And within days, the administration paused the tariffs, with the president admitting the bond market was getting, quote, a little queasy. Read that again. The policy of the world's most powerful government got reversed in under a week. Not by Congress, not by voters, by bond traders. So why should you, a person with a normal life, care about any of this? Because remember the formula. Your mortgage is the 10-year Treasury plus 2. Every dollar of new debt, every downgrade, every nervous foreign investor puts a thumb on the scale that prices your house, your car, and your boss's payroll. The government's credit card bill is your interest rate, which raises the only question that actually matters. What are you supposed to do with all this? Quick reality check before this part. I am not a financial advisor, and this is not financial advice. This is the stuff I genuinely wish someone had explained to me years ago, back when I thought a Treasury bill was something Congress votes on. Number 1. Stop donating money to your bank. The national average savings account pays about 0.5%. Meanwhile, 3-month Treasury bills pay around 4%. Money market funds pay around 4%. The best high-yield savings accounts are right there with them. Same money, same safety, 8 times the interest. T-bills even come with a bonus. The interest is generally exempt from state income tax. Your bank is counting on you never watching a video like this one. Disappoint them. Number 2, know the difference between a bond and a bond fund, because it bit millions of people in 2022. If you buy an individual treasury and hold it to maturity, you get every payment plus your full principal back guaranteed. Rates can do whatever they want. You do not care. A bond fund never matures. It is a basket that is repriced every single day, which means when rates rise, the losses show up on your statement and just sit there. Neither one is wrong, but one of them can show you a minus sign on a safe investment, and you deserve to know which one you own before it happens. Number 3, check your duration. That number we talked about. It is listed right on your fund's fact sheet, and it is your honest risk label. Short duration, small swings. Long duration, you are making a bet on interest rates whether you meant to or not. The retirees who got crushed in 2022 were not reckless. They just owned duration they did not know they had. Number 4, if inflation is your nightmare, the government literally sells insurance for it. Series 1 savings bonds currently pay around 4.3%, and the rate adjusts with inflation. Back in 2022, they paid 9.62% and were briefly the most exciting product in America, which tells you everything you need to know about 2022. Tips do something similar inside retirement accounts. Boring? Deeply. But boring that keeps up with your grocery bill. And number 5, watch the 10-year. Takes 5 seconds. Check it once a week. When it climbs, mortgages, car loans, and corporate borrowing follow. When it falls hard, the market is usually bracing for trouble. It is the closest thing the economy has to a check engine light, and now you are one of the few drivers who actually knows what it means. Here is the thing nobody tells you about the bond market. You have been participating in it your entire adult life. Every mortgage payment, every car loan, every dollar in your 401k's stable value fund, you were always in the game. You just never got handed the rule book. And there is an entire industry that is perfectly comfortable keeping it that way. But now you know the one rule everything runs on. Rates up, prices down, and you have watched it take down a bank in 48 hours, a prime minister in 45 days, and trillions in supposedly safe retirement money. None of those people thought bonds were boring afterward. You do not need to trade bonds. You do not need a finance degree. You just need to stop being the only person at the table who does not know what that 6.5% actually means, because the bond market is going to keep pricing your life either way. The only question is whether you can read the price tag. If this video shifted how you see money, hit subscribe. We are building a community of people who refuse to accept the default financial script and choose to engineer their own future. Your time is your most valuable asset. Invest it wisely. I will see you in the next one.